Welcome to our 6th weekly edition of Get More with Roar. This week we are going to be discussing another question that impacts our clients and their investments. But first, I want to take a moment and say a great big thank you to all of my friends and family that took the time to wish me a happy birthday this weekend. Each and every one of you enriches my life in so many ways, and I'm thankful to have you in my life. Now, back to business. Good morning, I'm Taj Roar of Roar Capital Management, and remember, the following is not financial, legal, or investment advice. It is for informational and educational purposes only. The question this week is, what is an exchange-traded fund? A growing number of investors are using this thing called an exchange-traded fund, or an ETF, to build a diversified portfolio. Let's define what an ETF is. An exchange-traded fund is a basket of securities, stocks, bonds, commodities, or some combination of these that you can buy and sell through a broker. ETFs offer the best attributes of two popular assets. They have the diversification benefits of mutual funds while mimicking the ease with which stocks are traded. Like mutual fund shares, ETFs represent partial ownership of a portfolio that's assembled by professional money managers. An ETF works like this. The fund provider owns the underlying securities, designs a fund to track their performance, and then sells the shares in that fund to investors. Shareholders own a portion of an ETF fund. Investors in an ETF that track a stock index get a lump sum dividend payment, or the dividends are reinvested for the stock that make up the index. Originally, ETFs were organized as unit investment trusts. In a UIT, an investment company buys a fixed portfolio of securities and then sells the shares of that portfolio to investors. This type of structure results in dividends being held in an interest-bearing account from which they are deposited into the ETF generally once per quarter. The delay in investing dividends can have a slightly negative effect on the total return of the ETF because the dividends are held as cash instead of invested. Other ETFs are structured as open-end funds. These arrangements follow the typical mutual fund structure in that new shares are continuously offered and redeemed by the investment company. An open-end structure allows dividends to be reinvested immediately. So if you're looking to invest but want to remain somewhat diversified, ETFs may be a good option for you. We certainly use a lot of them here at Roar Capital Management. Thank you again so much for spending a few minutes with me today. Next week, we will be talking about the difference between active and passive management styles. If you would like to get more information about us or meet with an advisor to evaluate your situation, call us today or check us out online through our website or Facebook page. Until next week, stay safe and blessed, and always remember, get more with Roar Capital Management.